Case 7 here, structuring a transaction with an investor. Ivan has sold a free and clear investment property for $250,000 and is anxious to complete a 1031 exchange. Why is he anxious? Because he owned that property forever, had a low basis in it, was going to get hit with a big tax bill if he just took the cash and reported the sale. Okay? Are there some people out there who are really adverse at paying taxes? We won't mention anybody's name, but some people just hate paying taxes. And sometimes they do things that don't make a lot of business sense to avoid paying the tax. Well, this made business sense because he was going to avoid paying the tax on this property, which might have been $20 or $30 or $40,000 in taxes. So it made some kind of sense. And I made it easy for him. I said, well, here's the deal. We'll let you take that $250,000 and we'll put it into a piece of real estate, a house here in town. Okay, but you don't have to manage it because I will lease the house back from you. I'll give you a return on your $250,000 cash. Is that a good deal for him? He gets to invest the whole $250,000. And what people in this situation think about is, well, if I paid taxes, I'd only end up with $200,000. How can I invest the $200,000 to make the same return that he's going to pay me on $250,000? In the end, it's pretty hard to do that, isn't it? So if I can pay him a return on the whole $250,000, it's a terrific deal for him. So we do the 1031 exchange. He ends up with this house that I leased from him. And why would I lease a house from somebody? Just because I like them? No. Why would I lease a house from somebody? Because I could lease it to somebody else and make a profit, right? So that's one motivation. And why else do you think we did this deal? What's the name of this course? Lease option. Because I negotiated, I said, here's the deal. I will give you all your money back, plus, if you see a little series of prices down here at the bottom. If I buy it within the first 24 months, I'll pay you $275. And how much did he pay? $250. So that's a profit, right? If I buy it the next 24 months, I'll pay you $300. If I buy it the next 24 months, I'll pay you $325. Why do those numbers make some kind of sense? What's the house worth today? $350. $350. So all I've got to do is sometime during the next 6 years is sell it to somebody else for more money. And the chances are pretty good I can do that because I got a good deal, good house, under market. So I turned around and I sold this house in a lease option. Okay? And when they finally exercised their option, I was able to pay off Ivan. Now here's the good news, kind of good news. When you pay off Ivan, is he happy? Call you up and you're Ivan. I say, Ivan, I got your check for $300,000. Who do you want me to mail it to? What's he get to do on the $300,000? Pay taxes again. He said, whoa, 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 whoa. Maybe we can do this deal one more time. Do you have anything else we could buy? And the answer is sure. I'll find something. Because it doesn't have to be something I own today, does it? It can be something I'm buying. It can be something I'm buying. So you're always looking for deals like this. It's a good idea. If you had a house, let's say I had this house already under a lease option. If I've got an option to buy something, can I use some other investor's money to buy it? Couldn't I sign my option to Ivan and let him close on a house that I already had? What if it was two houses? Couldn't it be two $200,000 houses instead of one $350,000 house? So if you're in the business, you want to keep something in inventory at all times. And one excellent thing to keep in inventory is a house that you want to buy in a lease option. Okay, I think we've covered everything on that page. Let's look at page 21, pre-lease option purchase checklist. I do not have time to read the entire list to you and explain every one, but I think they're all pretty self-explanatory. Couple things. Let's do this. Number 7 says make the offer in person or insist on acceptance or counteroffer. Let's look at a contract real quick on page 44 and 45 in the back of your book. Now, you'll see a series of contracts back here. Some of them are for buying and some of them are for selling. You should note the difference. And the buying contracts are in the front. That makes it a little easier for you. So the first page you're going to come to on 44 there says short form lease option contract, and I put in there for buying. You should take that for buying out, and you really shouldn't. Is it 41 in your book? Well, you know what? you've got one of the books that got misnumbered. So you have a special book. You know, sometimes a dollar bill gets printed upside down or worth a lot of money. Yours is that book. So that book is worth a lot of money. But if you'll add 3 page numbers to everything after page 27, you'll be right. But you're on the right page. You have all the same pages, and I've got the same book you do. See, I just renumbered mine. But that's the page we're on. This is just for an example in a class book. You can use this. I mean, this is a real contract. It's got a lot of good language in it. But I tend to make my deals on a yellow pad or a back of an envelope and write down the basics of the deal before I even pull out a contract. I want the people to understand the numbers in the deal. And the numbers that are important to somebody on a lease option is, number one, how much a month they're going to get. And they'll be thinking about how that relates to their loan payments. So if you say, I'm going to make your loan payments, that makes it pretty easy for them to do the math, doesn't it? Because they know the loan payments are going away. And then how much are you going to pay them when you buy the property? So if you're going to pay them $10,000 or $40,000, you can just write that down. That we'll pay all the closing costs, and I will buy your property for $10,000 over your loan balance sometime in the next 5 years. And you write it down just that clearly. Now, after you get that part done, after you talk about how you're going to make your monthly payments and how you're going to pay them when you buy the property, the rest of this is important, but it's really not that negotiable. Those are the 2 things that are negotiable. Okay. Now, if you're going to take over somebody's loan payments and pay them $10,000 over their mortgage balance in 5 or 10 years, what's real important to know? All the details on that loan, right? To make sure it's going to be in place and the interest rate's not going to change and the payments aren't going to change and it's not some kind of screwy loan. So you'll see if you look at this page that we ask for all that kind of information. We want the legal description, the owner's names and the street number, but then a lot of information here talks about what kind of loans they have, any other liens they have, if there's a second on here. We want all the information on the property that we can get now, because that helps us to make a good decision. When you use a contract like this, which is a form contract, or you just hand type one out, every line on this contract is part of the negotiation to purchase this property. So once you get the kind of the big picture figured out, how much per month, how much you're going to pay them, what loans you're going to take over, then you go through some of the details and you start asking people questions like, who are the owners of this house, and see how they respond. If they won't tell you who owns the house, what's that a sign of? They're not quite, well, they probably, they don't know, that is a bad answer, but they're probably not quite ready to do business yet. So that's how you figure out whether or not people are ready. And if somebody won't tell you who owns the house or won't show you the legal description, you can figure that out, right? But you don't want to figure that out. You want them to tell you, because that's a sign that they trust you and want to do business with you. If they won't tell you, what should you do? No. You should slow this thing down a little bit and talk about something else. I mean, something else that has to do with the house, like, did you remodel this house yourself? How did you choose that? The shag carpet on the wall, you don't see that much. You start talking about the house and just kind of normal stuff for a while, and then you come back, and at some point, if you feel that these folks need to sell this house today, you should say something just as clear as, okay, are you ready to sell your house? And see how they respond. And if they say no, now you might want to come back in a week or 2. I wouldn't leave them alone. Once I determine that people need to get rid of a house and they're going to sell it to somebody cheap, I might as well be that person. That's the way I feel about it, But sometimes it takes some perseverance. Sometimes you have to go back more than one visit. And what does that do? Let's say you've gone back and see somebody 3 different times. What does that do? You start to develop some familiarity with these people, a little relationship. I mean, not like you're best friends, but they're not afraid of you anymore. They're not afraid. You build some rapport. So sometimes it takes that in order to buy property, and especially because when we talk about lease option, it's a type of owner financing, isn't it? They're going to give you their house, sort of like leasing a car. They're going to give you the house and trust you to do something good with it. Well, they have to trust you. They have to believe this is going to work. So that's part of what the contract does. It tests that trust, and then as you go through the contract and fill it out and start reading these paragraphs to them, because you should. Before you read the paragraphs to them, what should you do? You should read them all by yourself. So you understand what the paragraph says, so you can explain the paragraph in one sentence. So you can say, okay, what this paragraph says is, and then you can read the paragraph to them or let them read it. You have a question?
When you are buying, are you putting the lease and the option together, and when you're selling it, you'll sell it separate?
I can do it any way you want to, but when I'm buying, typically the lease and option, unless I'm going to split them for some reason, will be all on one contract, on one document. When I sell, I always use two documents. I always use a rental contract, which is my normal rental contract, and then I use a separate option contract. And the reason for that is obvious. If I ever go to evict, I want to use the rental contract is what I submit to the judge, And then we'll talk about the option contract if they want to, but we want to talk about the rental contract first. So a couple things that are a little different here at the bottom. Look at paragraph 7. Let's see if you can read that in small print. It says, the buyers shall pay for all repairs costing less than $100 a month. Repairs costing more than $100 a month will be paid by the owner. You with me? Okay, should the owner fail to make repairs or maintain the house in its current condition, the buyer may have said repairs made and receive a credit equal to 200% of the cost of the repair toward the purchase price and a full credit toward the next payment due. Well, let's just do a little math. Let's say the air conditioner dies, and let's say you can buy one for $3,000, and you're supposed to be paying these people $1,000 a month. Would you rather keep paying them $1,000 a month or pay the $3,000? Well, if we didn't have this paragraph, which would you rather do? You'd rather pay $1,000 a month and let them pay the $3,000, wouldn't you? Well, let's make it a roof. Let's make it more interesting. Now it's a $10,000 roof. Would you rather write the check for $10,000 or pay them $1,000 a month? $1,000 a month. Okay, it's more interesting, doesn't it? So here's the point. If the only penalty to them is that you're going to make the payment to the roofer, $10,000, and then pay them $1,000 a month for the next 10 months, that's not much of a penalty, is it? That's not much of a penalty. If you think of it, it sounds like a lot, but it's really not. If we just trade dollars here, there's no penalty. So I want them to put that roof on, and that's why I say we're going to take, not only get credit for the next payments due you, but we're going to knock 200% of the cost of that off of what? Purchase price. So if the roof costs $10,000, does it add $10,000 worth of value to the house? No, it doesn't. So you got to be in the real world here. So we're going to take 2 times $10,000, $20,000 off the purchase price. Now, does that seem fair? Who said no? Okay. Which side is not? Is it not enough money, or is it too much money? I can't. Ann, I can see just the top of your head, so I got to stand up. What part of it's not fair? You think it's too aggressive? It's too much money?
It's aggressive.
You think it's too aggressive, though? I mean, are you uncomfortable with this?
It would accomplish the goal.
Well, but isn't that what we want?
Yes.
That's what we want. Let's say we don't take any credit toward the purchase price. We just have credit toward the payments. How is that going to affect your life if something big goes wrong? See? And it doesn't penalize them if they do what? If they make the payments. If they fix the air conditioner, there's no penalty. If they fix the roof, there's no penalty. Now, you have to use a little common sense. If it's got a bad roof and you know it's got a bad roof, you better talk about that going in, right? No reason to set up a problem. But if it's got a new roof, this is not going to be very scary. If it's got a new air conditioner, this is not going to be very scary. We're saying we want you to do it. Now, is this negotiable? Sure, it's negotiable. You do anything you want. I mean, this isn't a law, is it? This is just a thought. Okay, so a couple things you could do. If you feel like this is uncomfortable, one thing you could do is raise that $100 a month to a bigger number, couldn't you? You could say, we'll take care of the first $500 a month in maintenance, and everything above that is yours. See what I'm saying? So you could change that, make yourself happy if you want to, but understand that in the real world, when you get involved in these deals, when something big breaks, you have to protect yourself. You have to have a reason to come back to the table, because in a real world, most of the time, they're not going to write the check for $10,000 for the new roof. You're going to have to write it. And if you have to write that check early, if you're a little short on cash this month, $10,000 is a lot of money, isn't it? So you have to make sure that you're going to feel good about this, because otherwise it may just blow the whole deal. You may have to walk away from it rather than pay the $10,000 to put a roof on. And you may have an investment. You may be 3 years down the road on this house, and that costs you money. So I think these are pretty fair. I really do. But the question is, if you get in front of a judge, okay, would they think they're fair? Okay? Now, I've never been in front of a judge with this agreement. Never have. But if somebody wants to sell me a house, they probably really want to sell me a house. It's not like maybe we want to sell it, maybe we don't. They want to get rid of this house, don't they? They don't want this house back. They don't want this house back. So something that's not too tough works. And I haven't had people object to this. I can tell you we've done this many times. If you like that one, get on the next page. Look, we skipped over paragraph 8. Paragraph 8 says the seller agrees not to further encumber the property or sell any interest. They agree not to refinance the property or modify any existing loans. So we don't want to modify any existing loans. That means borrow any more money. Or to transfer any interest in the property during the term of the agreement. Okay, and you want to write that down again and record it. That's in this agreement. You could record this agreement if you wanted to, but you want to make sure that somebody reads that. So I suggest bigger print. Because if you record this, what happens to the size of the print? Even gets smaller, I think, sometimes. I think they shrink it. Okay. Paragraph 9 talks about loan payments and taxes and insurance. Is it important to us that they get made? Yeah. If somebody stops making a loan payments, house goes into foreclosure, my option's probably not going to be worth saving, right? You're going to lose the money you have. So it says exactly the same thing. It says if they don't make the loan payments, we can make them, get full credit toward the next money due them, and receive a 200% credit toward the purchase price. Same deal. Same deal. Okay, so if you're uncomfortable, make it so you're comfortable, but know the effect on your pocketbook. Now, the safest deal is to make the loan payments yourself. If somebody doesn't have a lot of equity, or if somebody has a lot of equity, or you have a lot of equity, you want to make sure that doesn't disappear. The safest deal is to make the loan payments yourself. Proration, taxes and insurance, and then loan interest will be prorated as the date of closing, no big deal. 11 talks about executing and placing in escrow with an attorney or a title company instruments needed to convey title. But remember my speech here 20 minutes ago about getting a new deed. That's important. And it also says that the buyer will deposit, and the buyer's me now, lease option buyer, that's me. The buyer will deposit an executed quick claim deed, which will be delivered to the seller in the event of a default by the buyer under this contract. So if I walk away from this deal and I don't close on it, they'll have in their file a quick claim deed for me that shows that I have no interest in the property. I don't even want to go into whether or not that effectively does anything, because depending on the date of it, when it was transferred, a lot of discussion on whether or not it's any good at all. But we put that in there just to balance out the fact that they're going to sign a warranty deed, we're going to sign a quick claim deed. Going in, there's some balance in there. Damages. The important thing about paragraph 13, it says, number one, if they don't perform, we can sue them for specific performance. And I was tangentially involved in a deal here about a year ago where it was a big deal, and the sellers refused to perform. It was an option. The sellers refused to perform because the property had gone way up in value. It doubled in value. And the buyers had an option to buy it at a cheap price, and they went to court, and the judge said, sorry, you signed it, you took their money, you had a valid contract to sell it at this price, you're selling it, and he made them sell it. So a contract does work. Contracts are enforced in law. But it says in the event the buyer, that's me, the buyer fails to exercise, the option consideration and rents will be paid will be forwarded as full liquidated damages. So that lets me off the hook. And that's not a bad line to put in any contract you sign, because you don't want to have liability in these contracts. Recording says all parties agree that this agreement or a memorandum, including any parts of this agreement acceptable to the buyer, can be recorded. So if you want to put something on the public record, which is an excellent idea, you can. 15 talks about successors and subletting. It says we had the right to sublet it, the last line there. 16 talks about access and advertising. It says that the buyer may advertise the property and immediately have access during reasonable hours to show the property to others. That works with an empty house. If the house is full, that's not going to work. But if I lease option an empty house from somebody today, when do I want to take possession? Today. I want the keys. I want to go and have somebody mow the yard, make it look good, right? I want to start right now. Time is of the essence, typical in contracts. And then one other thing here under other terms, Make sure, because this contract itself doesn't speak to this directly, about the insurance we've talked about. Make sure you put in that under other terms, or type in a new paragraph that says that the seller agrees to name you as additional insured on both their liability and casualty policies and furnish you a copy of it within 10 days, short period. Make sure they get that done, because that's the type of thing that they can forget to do, and it can be very important. So there's a lot more to this. Go back and read every word in this contract. And then behind this contract, you're going to see several other contracts. The first one on the next page says purchase option contract when buying. And this is just a straight option contract to be used with a lease. It covers a lot of the things we just said, but it's on a word processor, a little easier to read. The next contract is an actual contract we use with our IRA to have an option to buy a property. And if you've heard me talk about investing in our Roths, you know I like one of my favorite investments in my Roth is an option. And the next page is a long-form contract drawn by a prominent law firm here in town, so it's got a lot of really good language in it. And it's good to use an attorney to draw up an option contract for you once, because once they do it once, you've got their contract. You don't need them a second time. Again, if you're going to use these contracts, and you're welcome to use them, they're not copyrighted or anything, but read them very, very carefully. And if it's a big deal, I mean, if you're putting up $50,000 and you're going to make $1 million, who are you going to hire? Best lawyer in your town. You want to make sure this is done right so you get paid. And that's the mistake people make sometimes is they're able to get into a deal with a nominal amount of money, so they get sloppy on the paperwork, and you know, they wake up 5 or 10 years from now, there's a lot of money on the table and they don't get to keep it. So pay attention to paperwork. It's an interesting part, I think, but it's also a very important part. On page 55, back in the appendix, you'll see a form titled Memorandum of Option when buying to be recorded. And I mentioned earlier that if you record, for example, that first little contract we went over, the kind of the form contract, the print is so small in that people might miss something important. If you're going to record something and your goal is to cloud the title, you want to make sure that people can read what you recorded. So you'll see this is typed in 14-point type. It's easy to read. And we have on the top, we have the people's names. We have the legal description. We have them signed down at the bottom. And these are the things you want. And if you read what this memorandum of option says, it gives the term. It says, as part of this agreement, Joe and Sally agree not to further encumber the property nor sell any interest in the property during the term of the agreement. Any encumbrance placed on the property after this agreement is properly executed and recorded, including leases, will be subordinate to this agreement and will be extinguished by the proper execution of this contract. Now, I'm not sure that last line is accurate. We can't really make law with this contract, but it'll get people's attention, won't it? That's the whole idea. But the legal description, the names, the agreement not to further encumber, those are all important. Number 3 says it'll bind the heirs, executors, administrators, successors, legal reps, and the signs of each party to this agreement. And that's important. That's important to put in any contract. But again, what are we trying to do? We're trying to put people on notice who have the reason to do a title search. Who's going to do a title search? Somebody trying to buy the property? Somebody that might make a loan on the property? Some personal representative of the property, okay? Somebody who has some legal interest in this property. Then the last one talks about foreclosure. It says, in the event of a foreclosure, the owner's equity at the sale and any right of redemption shall transfer to the optionee without further compensation. So what does that mean? That means if there is a foreclosure sale, and again, I'm not sure this is street legal, but if there is a foreclosure sale, they're walking away from their rights. Now, if there's a foreclosure, what's going to happen? If these people get behind in their payments, that means they're not making their loan payments, right? Shouldn't you be in a loop? Shouldn't you be talking to these people? And if you have a bunch of money or a bunch of potential profit, you should be talking to these folks and try to solve that problem. So foreclosure should not be something that happens very often. And then it says, should serve as conveyance without further action. Again, we just made that up. I'm not sure that will work. But you know, you can write stuff down. It doesn't mean it's going to work. You can write stuff down, but it gets people excited, right? And what you don't want is competition on this property. So you're trying to scare off your competition with something like this. But part of this is enforceable. Part of it does make sense. Their agreement not to further encumber the property or sell any interest, that's going to slow them down. And that's all we're trying to do is slow them down. The next page is a letter of instructions to the lender. Remember I said when we buy a house from somebody and they have a loan, we want to start making the payments on that loan. So that's what this letter talks about. It's from them. It's from the house, the homeowners. It's to their existing lender. We reference the loan number, where it is. Please be advised we've retained a management company in Sarasota to collect the rents and make the loan payments on the above property. And the loan of the company is, that's me, beginning with a check due on January 1st, 2009. Your check will come directly from Florida Coast Realty. Please send future statements or notices requiring changes in the amount of payment due directly to them. So that's important. We want to make sure that we hear about it if they're going to change our payments. So taxes, insurance payments, and as we talked earlier, they change all the time, don't they? So you want to be in that loop, because if you don't make the right payment, what will they do? If you send the wrong payment into the bank, what happens? They might just put it in a file. I mean, they probably won't apply it to your loan. They're not going to send you a nice little note, say, please send $8 more. They never do that. So it's going to be trouble. So you want to stay in the loop and just be on top of this. If you're not going to do 100 of these, you might do a half a dozen, you might do just one. But stay on top of it to make sure the mortgage payments are getting made. Okay, so I think we're back on page 22.
John,
Yep.
when you record this memorandum of option, how is it cross-referenced to your particular property? Or is it?
Well, it's got a legal description in there.
Somehow that it gets cross-referenced somehow. I guess.
Cross-reference to what?
In other words, let's say they did sell the property or something, the title company never noticed the memorandum of option.
Okay.
Somehow it got by. How is that corrected somehow so it's not passed by? Because it could happen, I guess, right?
Sure. Well, they miss mortgages. I mean, title companies miss a lot of things in title searches. So if they just missed it, think about how this is playing out in the real world. Who occupies this house?
You're leasing it to somebody else.
A tenant, right? Okay. If you were going to buy this house, wouldn't you want to see the inside of it?
True.
Right? And so aren't you going to knock on a tenant's door or call me? I mean, so there's probably going to be some interaction. I probably know that this house is being sold to somebody else, just realistically. So at that point, we're going to get a hold of the people who own the house and say, look, you can't sell it. We recorded this. I'll call the title company and tell them it's there. So we try to hit it off before there's a title transfer. If there's a title transfer, I'm going to hire a lawyer and say, look, we've got the right to buy this house at a certain price. And let's contact the new owners and tell them we want to exercise our option. That'll get people excited, especially if they pay more money for it, right? Because you're just trying to make something happen here. And you want to do this right away, of course, while the seller still has some money, because you really want the title company to pay you and you want them to go after the seller. So, I mean, it's not going to happen often, but because you have possession of the property, it's pretty unlikely they're going to sell this property to somebody else without some kind of inspections, right? It could happen.
Right.
I mean, they could exchange it. They could do a 1031 exchange or just trade it to somebody for something else. Somebody might just take it, but they're not very wise if they don't they don't talk to somebody who's in possession of the property. So possession is important. Okay, I think we're on 22. Does that look right to you all? Okay, so we're on a paper checklist when buying. Use a contract you and the other parties fully understand that protects your interest. How do people get out of deals they don't like? They tell the judge they didn't understand the contract. They didn't understand what they signed. Use something that's really clear, okay, and make sure everybody involved in the deal understands it. Get them to sign it, and the chances are pretty good you won't have a problem. But the folks that have problems either use a contract that's convoluted where nobody understands it, or they go so fast that the people who are selling really don't understand what they're getting into. If you're ever dealing with somebody that you think might be incompetent, okay, somebody who's up in age maybe and maybe doesn't have the capacity to sign a contract, and that could be somebody very young too, of course. Well, if that happens, you don't have a real deal. So be careful about that, because in like Florida, for example, a lot of elderly people have houses and they might make you a deal, and then their kids would say, well, they didn't understand what they were saying. Sign it. Yes, sir.
What if they have a lawyer read over the contract and okay them? Then you should be fine?
That would be good. The question is, what if their lawyer read over the contract, make notes to the lawyer, who it was, and make a lot of good notes. Probably can't get the lawyer to sign anything, so I said this is okay, but at least you could tell the judge, the lawyer, they were represented, and that would help a lot. That would help a lot. Number two, when you want to separate the operating income and liability from potential capital gain, use two documents. You can use two documents to buy under a lease option. You have a lease, you have an option, right? Two different pieces of paper. You'll see copies of the contract in the back, which is separate than a lease, just a separate option contract. So if you want to separate the option from the lease, for example, if you wanted somebody's Roth IRA to fund this option, and they wrote a check for $10,000 to buy an option on this house, and your corporation leased this house for the next 10 years, that's two separate profit centers, right? And they may be tied together. The option may not be good unless lease payments are made. So they better be friendly, and because otherwise the investment that the Roth is making is pretty high risk. But if lease payments are made, their option is good, to exercise their option, could be a nice profit for the Roth. The corporation who's doing the leasing could be making a nice profit on their side. But would a Roth want to do a lease option? Would a Roth want to operate a lease on a house? Probably not. There's a lot of moving parts, maybe some risk. They're better off with just the option. So you can split these things up. And you should think that way. It could be just two different individuals. It doesn't have to be a corporation, but two different people could do this. You have to be a little careful with your Roth strategy, because if you can't take both sides of that, it wouldn't be smart for you to be leasing a property and have your Roth have the option, because if they looked at it, which is a long shot, but if they looked at it, they being the IRS, they might try to argue, well, what you're doing is you are improving this property, making the option more valuable, and that's a no-no. That'll cause you trouble. So it would be best, if you're going to do this and there's a lot of money on the table, to use people that are unrelated. Okay? And Peter Fortunato and Dort Dykes-Botifer teach a class on IRA investing on a regular basis. You should take that if you're going to do something like that, because Dykes will probably try to talk you out of it. He's pretty conservative. Use a lease that allows you to sublet. We've talked about that a lot this morning. Use a lease that has a liquidated damages clause. Again, we talked about that. That's very important. Check the title. Make sure the people own it that are signing it. Record your memorandum of option, which we just went over. Make the loan payments directly to the lender, and we just saw that letter to the lenders. And then require the owner to name you as additional insured. All those are important. So make sure you come back and read this checklist when you do a lease option, just to make sure you've got all the bases covered here. Next page, protecting yourself against misadventures of the seller. People are always concerned, and you should be concerned. What if they file bankruptcy? What if they don't pay the property taxes? What if they don't insure it? What if they don't maintain the property? What if they sell to somebody else? All these things can happen in the real world. So again, use some common sense and choose who you deal with fairly carefully. But even good people go bad, or good people make mistakes. So you want to have as much protection as possible. And so here's a couple thoughts. Number one, we talk about this memorandum of options. So make sure they sign that, record that. Number two, if there's any significant money involved, and that can be $1,000, record a mortgage and show that $1,000 as the amount of the mortgage. Have a stated interest rate, let the interest accrue so they don't have to make any payments, but get in the chain of title. Now you're a secured creditor. Anybody ever had any experience with bankruptcy? Not yours, somebody else's? Unsecured creditors get paid how? They don't, somebody says. Well, if they do get paid, how do they figure it out? How much they get? They spread it out, don't they? Kind of prorate it. Everybody gets a sort of equal amount. Who gets paid first in a bankruptcy? Attorney, somebody said. But as far as creditors go, it's the secured creditors, right? Now, every once in a while, the judge will do something really weird and treat the secured creditors like unsecured creditors, but typically, the secured creditor, like the first mortgage holder, the second mortgage holder, get paid off because they're in a secured position. So you just want to be there. Three, have the seller deed to a third-party trustee with the seller as beneficiary, and then buy their house from the trustee. If you think the people you're buying from are about to get in trouble or look high risk to you, but you want to make this deal, this is a way to get the property out of their name. Get the property out of their name. So if you're buying a house from me and I look like I'm just about to get in I'm kind of sketchy, you know, I owe a lot of people money and I'm not paying my bills, and you want to try to make this deal work, you want to transfer the property out of my name into somebody else's name, who would probably be a trustee. They don't really want to own the property. They could be a trustee. I could still own the beneficial interest. And by doing that, by buying from the trustee, you're buying from somebody who's not going to get involved in some legal action. To make it even cleaner, what could you do? You could have me actually sell the property to somebody. Okay, let's say I'm going broke and I need 10 grand in a hurry. And I sell my house to Kevin for the 10 grand. But Kevin says, whoa, I've got 10 grand, but I don't want this house. I say, Kevin, don't worry about it. I've got somebody else going to buy this house from me right now on a lease option. They're going to give you some money, down payment on an option. They're going to lease the house from you. So you're going to make a profit on this deal. So you have a third party who's a real person, or it could be a real corporation, but somebody steps in and holds title, and the other guy is completely out of it now. Because if somebody does file bankruptcy, a lot of times the judge will look back and see what transactions have happened recently, and if they see somebody has used some kind of transaction to defraud their creditors, they'll reverse that transaction. So it has to be arm's length. It has to be some way close to fair market value. But I've been involved in a few deals, and many times it's not fair market value because it's a fast sale. And if I sell something to Kevin, he's not going to pay retail price. It's going to be a good deal. You know, it's going to be part of the deal. So the fact that somebody bought something for 80 cents on the dollar doesn't mean that the judge is automatically going to wipe that out. If it was a real sale, real party, they weren't related, it'll probably work. And then number 4, get name on your insurance policy for both liability and casualty, and then cover it with your insurance, your umbrella insurance. Make sure that you have full coverage on this because you're going to lease it to somebody. Something could go wrong, and so you want to make sure you're insured. And then check to make sure taxes are paid annually. So things you can do to protect yourself. That doesn't mean it's bulletproof, but it means that the odds are so good that you're going to make a profit that it's worth taking the risk. You know, a lot of this business is risk management. And I did a whole course on risk management a couple of years ago. But you have to assess the risk and say, is it worth risking my time and my money to put this deal together? You know, if the answer is yes, you know, and the answer, and you should say, is there at least a 90% chance I'm going to make a profit on this deal? And the answer to that should be yes, at least 90%. You know, that's almost a sure thing, isn't it? I mean, if it's a 50-50 chance you're going to make money, pass. Look for something better, because there are better deals out there. Okay. So we've blown through this pretty fast. I've covered a lot of material this morning. Any questions on buying with lease options? If you have, you can always email me later, but I'll be happy to answer them now. Yes, ma'am.
John, when you draw up a lease option, do you use your name or do you use a trust or yours?
When I'm buying on a lease option, I typically use my corporate name. It depends on what I'm going to do with it long term, but hardly ever my name personally. So it might say John Schaub Trustee, it might say Florida Coast Realty. I don't see any real reason to put my name on a deed anymore, so we don't do that. Okay, I mean, if you want to be taxed at a personal rate, then you want to be careful to somehow have that profit end up on your personal tax return, not a corporate tax return. If it's a subchapter S corporation or a partnership, maybe it flows through to you and you don't have an issue. But think taxes. Talk to your accountant a little bit because taxes are your partner always, you know. And if you don't think that way and you end up giving 20 or 30% of your profits away, you just won't be happy. You want to pay a capital gain tax and pay the lowest rate you can. Good question. We're on page 24. We're going to talk about selling using a lease option. Why do people buy on lease options? They can't get a loan. That's a pretty good answer. Because if people could get a loan today, wouldn't they be better off? Most of the time. I mean, most of the time rates are low enough, and you know, if their credit's good enough, they're better off just getting a property in their name, getting a loan. So you're dealing with people who can't qualify for a loan. Who are those folks? Why can't they qualify? They had a foreclosure maybe? What else?
Sketchy credit.
They got bad credit?
Sketchy credit.
Sketchy credit. I like that. And what does that mean? It means they're not paying their bills, right? So, and what else? Are there other reasons you can't get a loan? Maybe you have good credit. Maybe you haven't had a foreclosure. Is there other reasons you get turned down?
Just bought a new car, no credit at all.
Just bought a new car. Okay. No credit at all. There's a lot of people that don't have any credit. A lot of people tear up their credit cards, pay cash for everything, and what happens? They wake up one day and they have no credit, and they can't qualify for a loan. What else?
Low income?
Low income, okay. What about people just moving to town, just got here yesterday?
No job.
And no job. Yeah, that'll do it. Yeah. Yes, sir?
Plumber, like, or someone who works, gets paid in cash.
Okay. People have a cash business. Okay.
Moving overseas.
What's that? Okay. People move here from overseas. Okay, good. Well, and we could go on, but isn't that a pretty good sized pool of people already? And that's my point. There's always somebody who wants to buy a house if you'll finance it for them. And if the way you choose to finance it's a lease option, that's your choice. You're the seller. Okay, you get to call how you're going to finance it. So now you're just looking for somebody who wants to buy a house, who probably has some down payment, might have some credit issues, but has enough income to afford this house. So the income's pretty important, isn't it? If somebody's sketchy on their income, they don't have enough income to buy this house, don't sell it to them, because that's not going to get any better. But if they have some kind of credit problems, and the ones I see all the time are divorces 4 or 5 years ago and recovering from that, or bankruptcy 5 or 6 years ago, or foreclosure 5 or 6 years ago, a lot of people have issues. And if they have something that I think they can solve, then I'll sell to them. But I'm not going to sell to anybody that I don't think can buy the house. I want somebody to have maybe not a 90% chance, but at least a 50% chance or a 60% chance of making this deal work. Because it's an unhappy ending if they don't buy, and I don't want that. I want them to buy. Okay. The other side of it is I never sell a house on a lease option unless I really want to sell it. Some people use lease options as a way to reduce their management responsibilities. The problem with that is, and it might work short term, but once a buyer figures out they're not going to close on a house, what happens to the maintenance that they do on that house? It stops. They quit maintaining that house, and you show up 2 or 3 years later if they're still in there, and you find the house needs a lot of work. So just because you're not maintaining it, if they don't maintain it, the house is going downhill fast, and that can be a real problem. So it's not a very strong strategy. The flip side of that is, and this is the side that always worried me, let's say I have 10 really good houses, and I sell them all this year on a 1-year lease option. Okay, and I get some small down payments, $5,000 a house or something, so I pick up $50,000 in cash, and all that sounds really good. $50,000 tax-free because it all applies for the purchase price. And then the market goes up 25%. What's going to happen? 7 or 8 or 9 or 10 out of the 10 are going to buy that house. Okay, now do you want to sell all your houses when houses are going up 20% a year? Or it'd be better to keep them? Because if you'd done that 5 years ago and they had a 20% jump and you sold them all, now you have cash, you missed all this appreciation, didn't you? So I think that's a bigger problem for me because I have good inventory. I don't really want to sell my inventory. So to sell them on lease options to try to reduce management, that could be a bad plan if everybody bought in 1 year. I wouldn't want to sell a bunch of them in 1 year. Tax rates would be high. I'd have a bunch of cash. I wouldn't like that. So you need to be thoughtful about this. I do sell just about everything I sell on lease options, and the exception is things that I have foreclosed on in my pension plan that I want to convert back to a first mortgage again. I sell those and carry back first mortgages. But houses I own personally that are investment houses, and I've owned for 5, 10, 20, 30 years, I always sell those on lease options for a couple reasons. Number one, we get the most dollar. We net the highest amount when we sell on lease options. And number two, if I want to, I can do a 1031 exchange into other property and not pay any tax. Okay? And those are two big ones. Getting the top dollar, making the most money, and I'm talking about a 10, 15% swing in price there, and not paying any taxes, those two things combined make it an easy decision to make most of the time. So the only time we would take money out is if we needed money. If we needed money, then we'd sell, pay the tax, take money out. But if we don't need money, we keep rolling it over again. Keep rolling it over. Okay, so some advantages of selling on a lease option down here at the bottom. You retain title and the tax advantages, the depreciation, the ability to exchange, the ability to borrow against the property tax-free. So those are all big, aren't they? All big. D, it's easier to regain possession if I evict somebody rather than I foreclose. So if I sell, instead of a lease option, the other alternative is probably selling and carrying back a note and mortgage. But if I sell and carry back a note and a mortgage, and the people don't pay me, does it cost a bunch of money to get rid of them? How long does it take to get rid of them?
Like a foreclosure?
Depends on where you live. Yeah, a foreclosure. It wouldn't be like a foreclosure, it'd be a foreclosure. And in some places, it's several years to foreclose. Some places, it's only a few months. If you live in a deed of trust state where foreclosures are trustee sales and they happen faster, it gives you a little more parity to sell with a mortgage and deed of trust as opposed to a lease option. But if you're in a state like Florida or New York or places that are mortgage foreclosure states and it takes a year or 2 or 3 to foreclose, it makes it an easy decision. You don't want to take that long to foreclose. So if somebody does not pay me under a lease option, I evict using the lease. I evict for non-payment. If they raise the defense that they have some equitable interest because they had an option in the property, we discuss a couple things. To raise that defense, you'd have to have a couple things in your favor. One, they look at the amount of the down payment. Okay? If they had a small down payment, that goes in my favor as a seller. 2, they look at the term. So if it's a 1-year deal, does that look like a mortgage, a long-term financing, or does that look like a real option? It's a real option, right? 3, they look at the credit you're giving them. So if you give them a lot of credit each month, that works against you. 4, they look at a responsibility of doing the maintenance. So if you're delegating all the maintenance to them, that works against you. And then 5, they look at and see if they're damaged at all. So if they bought a house way below market and it went up and they're going to lose $30,000 because they can't exercise their option, the judge would take that into account. Well, who here is going to say sell way below market? Nobody. I'm always market plus 10%. So the chances are pretty good that a year from now, if somebody looks at this transaction and they see they've got an option to buy it for $275 and it's worth $275, they haven't been damaged. There hasn't been any real damage. So all we're talking about now is the amount of money they put down. And I'm just saying that the arguments are all pretty much in my favor, that the judge would not look at a deal like this and say it was an installment sale. There's the old legal term, if it looks like a duck, and quacks like a duck, and walks like a duck, it's probably a duck. You've got to make sure that whatever documents you use and the deal you put together with the numbers looks more like an option than it does like an installment sale. So if you sell to somebody on a lease option, take 20% down, have payments for 20 years, that's not a lease option. That's an installment sale. Even payments for 5 or 10 years looks like an installment sale, not a lease option. But it was a 1-year deal with a relatively small down payment, nominal credit toward the purchase price. It's an option. And I don't think you're going to have trouble with that with most courts. Number 2, this is reasons to sell on lease options. You still own the property. If you have some financing on this property and have the ability to renegotiate it or to discount it, you'll get the benefit of that. Once you sell the property to somebody else, you lose the control of that financing. Number 3, improvements made by the tenants might accrue to you and improve your property value. How many people have had tenants make a lot of good improvements to their property that increase property value? Almost everybody in the room. Just kidding. Yeah. Now, tenants, I've had a couple tenants do some nice yard work. I mean, there's been a few things that happen over the years, but if tenants will just hold their own, I'm pretty happy most of the time. If they just leave it looking about the way they did when they moved in, I'm generally happy. But lease option tenants tend to paint sometimes, and they tend to do things that you don't want them to do. So you have to talk to them. We had one house that did need a lot of work. I'll talk about it in a second, but they did the work. We've had other houses that didn't need much work, and people would try to fix things and mess them up. So you want to talk to tenants, and I try to restrict what they'll do. I do that in the contract. I restrict what I allow them to do in the contract. That doesn't mean they won't do it anyway, because I'm not over there watching them every day. They might paint something you don't want painted, or take something out you didn't want out, but most of the time it works out okay. The option consideration that applies to purchase price is not taxable until the transaction closes. So if somebody does give you $5,000 down, that's not taxable to you now. When is it taxable to you? When they close? What if they don't close?
It's not taxable.
No, it is. It's taxable when they don't close. If somebody gives you $5,000 today, and it's a 1-year lease option, and they don't close in 1 year, that $5,000 is taxable then. Okay? It's not free. It's never free. It's just when it's taxed. Okay? So the $5,000 is treated as part of the down payment. So let's say you and I just entered into a contract to buy your house, and I give you $5,000 down. We're closed next February. When do you pay taxes on that $5,000?
Next February.
Next February. Next February. So when the contract closes, or if I walk away from that $5,000 and I don't buy your house next February, you still have my $5,000. It's taxable at that point. So it's always taxable. It's just when it's taxable. Now, if you're selling a house and you have a capital gain in it, it's taxed as a capital gain. Okay? So that's the good news.
Well, when you give the seller $4,000 down, you're buying his house on lease option, does he not pay the tax until years later when it closes?
That's correct, if it applies to the purchase price.
Okay.
So when there's a down payment under a lease option, even if it's long-term, 5 years, it's not taxable until one or two things happen. They close or they abandon the option. Okay? So when one of those two things happens, it's taxable at that time.
Just to clarify something, you said that it applies to the
Purchase price.
Purchase
It applies to the purchase price.
but not to the down payment.
You can apply to the down payment too.
The bank will let
Sure,
them do
sure.
that?
Yeah, if I sell a house on a lease option with $5,000 down, that $5,000 applies to the purchase price and the down payment. It's their $5,000.
Only if they close.
Yeah, if they don't close, and we'll talk about that in a second, but if they don't close, something else happens.
Okay.
Okay, number 5, you can index the purchase price. You can index the purchase price. What does that mean? It means you can raise the purchase price. If you give somebody a 5-year option to buy your house, you can raise the price each year for the 5 years based on the CPI or any index you plug in. You don't have to, but you can. Now, I'm suggesting to you, rather than using a long-term option like 5 years, which is starting to look more like an installment sale, that you always use a 1-year lease option and then build a 1-year extension into it if you want to do that. So you can say they can extend by 1 year, but if they extend, the purchase price will go up by, and you pick a number you like, 3%, 5%, and the rents will go up by, and pick a number you like, 3 or 5%, depending on what your market's doing. And by doing that, you want to give them an incentive to close in that first year. And again, your game plan should always be to close in that first year. Now, a lot of times you will extend 1 more year, but you're not looking to put together a 5 or 10-year deal here. You want it fairly short term. You can delegate the maintenance of the house to the tenants, and maintenance not being capital improvements, small maintenance. And we delegate maintenance to all our houses to our tenants, small repairs, and that works pretty well, keeps me out of their house. It's like a deductible on your health care. And if you have a bunch of employees and you pay for the first dollar in health care coverage, I guarantee you they'll be sick more than if they have to pay for the first $100 in health care coverage, because then they think before they go to the doctor. Well, the same thing's true with tenants. If they have to pay for the first $100 in a repair bill, they think before they call me. If they can fix it themselves, they do. And a lot of little stuff you can fix for $5 or $10 and they don't call me. But the big stuff, the air conditioners, the roofs, bad windows, things like that, we pay for. They pay for the first 100. It's like a deductible. And we do the same thing here. You can offer it with a lower down payment, and that'll reduce the time it takes you to find a lease option tenant. Now, if you compare buying a house with a lease option for me, and I charge $3,000 to $5,000 down typically, from what it'll cost you to buy a house through a realtor or a FHA house or even a VA house, it's a lot cheaper to buy from me. A lot cheaper to buy from me, because a lot of those other deals will have the closing costs built into the price of the house, which raises the price of the house, doesn't it? Plus, who gets to move in faster? You buy from me on a lease option today, you get to move in this afternoon. Anybody beat that? So if somebody really wants to move into a house before school starts or before Christmas or before whatever it is, and I've got an empty house, I can move you in this afternoon. I just need real money. Okay, I know who owns the house. That's me. I don't have to worry about that side of it. I will check you out a little bit. We'll do a credit check and make sure that you're not wanted anyplace. But if you have the normal amount of cash, if you show up with $50,000 cash in a paper bag, I'm probably not going to sell to you. I may refer you to one of my friends, but I'm not going to sell to you. But if you're real people with real jobs and I can check you out, we can move pretty darn fast. And a day's pushing it, but you can move pretty fast. It doesn't take a month to close the deal. It can happen in a hurry. You get the benefit of any mortgage amortization. So if you're selling this house and you have a loan on it and your payments paid a loan down $300 a month, that's your $300 a month. You get to keep that. You will net more money. That's the bottom line. When I sell a house on a lease option, I generally sell it at a retail price. So if retail is between $250 and $275, the price is $275. I go for the high retail price and see if it'll work. I go with a low down payment, a house in that price range. We're charging $5,000 down right now. And we keep the rents about retail. So if the rent is $1,500 to $1,600 a month, that would be $1,500 a month in rent. A little on the low side. So when people look at this house, they see decent rent, not high, normal rent, maybe a little low, small deposit, purchase price, hard to tell if it's really worth $275, but that's what it says, so it probably is. That's what it says on the sign, $275, so that's got to be right. So which of those three are most important to you? The amount of rent you collect each month, the deposit, or the price? Which is most important? Price. Price is way more important, isn't it? So if you can go $275 instead of $265, but you give away $100 a month, wasn't that a pretty good trade? Yeah. So I'm not saying being way low on a monthly rent, but be on the low side of retail on a monthly rent. Be fairly low on your down payment, but enough to qualify people, because you want them at the end of the year to be in a position to qualify for a loan. Okay? So that down payment will count toward the loan. If you give them $100 a month credit, that's not going to come out to a whole bunch of money, but normally they'll let you count that without a lot of conversation. The rule is you're supposed to pay more than market rent to count that, but nobody argues over $100. So now you're at $5,000 plus $1,200, you're at $6,200. You've got to do the math and see what kind of loan they can qualify for, but you need to get them to a position where they can get a loan in a year, or you're not going to get paid off, right? Unless you're going to find somebody else to lend them the money. Comparing a lease option to a conventional sale on the next page. If you sold a house for $250, listed it with a broker, how long would it take to close it? I'm saying 30 to 180 days. 180 days being kind of long, but everybody else's house seems to sell fast, not mine. Ever notice that? It seems like all other houses are selling like in 3 days, and it takes yours 6 months to sell. So sometimes it takes longer than you plan on. It takes a while to close it. Once it gets when it's sold, that means it's under contract, right? I mean, it's done. Then you've got to close it. That takes another 30 days. So it can sit empty for a while, and that can cost you some money. Down at the bottom, though, if you have it listed for $250, you're probably a little aggressive on the price. Would you accept an offer at $240? Most people would. That's probably about what it'll sell for. You have to pay a commission if you list it. You'd have closing costs. So your net might be like in the $223 range. If you sold it with a lease option, there wouldn't be a commission. There won't be any closing costs. There won't be any repairs. You're right at $260. You can see there's quite a difference between those two numbers. $37,000. And then just call it $30,000. But isn't $30,000 enough to work a little bit for? That's a pretty good day's work. So it's worth selling them yourself without a realtor on a lease option, and we've had terrific success doing this. Another significant negotiable item is the date of the proration of the taxes and insurance. Normally, I say I'll pay the taxes and insurance for the first year, but if you extend into the second year, you have to pay the taxes and insurance. I want to give them as much incentive as possible to get it closed that first year. But sometimes people will come back at the end of the first year and they say, look, we need 6 more months. I said, okay, but remember we said the taxes and the insurance will be your responsibility in that second 6 months. Never a big amount of conversation about that, but it's a couple $1,000s, isn't it? I mean, if you're prorated for 6 months, it could be a lot of money. So I think that's fair because we want them to have this incentive to close in 1 year. And if they can't close in 1 year, we'll work out something else. And I'll show you some of the other stuff in a second. Next page, a couple of disadvantages. You have your cash tied up until the closing. So if I sell a house today for $250 on a lease option, I'm not going to get that $250 for a year. Although sometimes people close early. If rates start going up, I think people will do everything they can to close early right now. It is possible to borrow against the property subject to the lease option. When I sell a house on a lease option, I don't record anything. There's no memorandum of option. There's no contract that gets recorded. There's no mortgage that gets recorded. There's no affidavit saying I won't further encumber this property that gets recorded. I'm a seller. Different deal altogether, isn't it? Okay? Now, I'm not going to overfinance this property. I'm not going to borrow more than the purchase price. But if I needed to borrow $50,000 for some reason, I could borrow against this house because it's still my house. Still my house. There's nothing of record. and there's nothing fishy about that. Not all lease option sales close, so there's three options when the tenants don't buy. You can renegotiate the rent option. You can give them another year. You can ask them for more money, although it's been my experience that most people won't give you more money. You can just continue to rent to them. Okay? And that's happened many times where people will be in the house, they like the house, they just can't afford to buy it, they can't get their act together to get their credit straightened out where they can buy the house. So we continue to rent to them. If you do that, make sure you get some kind of release from that option. I don't care how casual it is, but get them to sign something to say that they understand that their option is expired and no longer in effect, and that their security deposit, which I'll go over in a second, I don't think that's me, is it? The security deposit is so much money, and they'll get that if they stay in the house a certain period of time and give it back to you in good shape. Question?
In your experience as a seller, what percentage of your lease option deals actually close or don't close?
Well, the question is, what percentage of the lease option deals sales actually close? It's totally dependent on the credit market. If the credit market is getting looser, like it is today, I'd say the next 2 or 3 years, I'd say 50 to 75% of them will close. A lot of it depends on my selection, who I sell to. I can sell to people all day long who don't have a chance in the world of closing. Okay, they'll give me $3,000 for a chance, but I know they won't close. So depending on how I select people, that number is going to vary. As I've said a couple times already, I never sell a house in lease option unless I want to get rid of it. Ones I'm selling, I'm selling. I don't want them back. I'm not looking for a sell it, get it back, sell it, get it back. I want to get rid of it because I want to do something else with my money. So those, because I'm picky about who I sell to, the percentage goes way up. It may be 50 to 75%. Yes, sir.
That $5,000 for the option consideration, when you just extend it to where they're going to be a renter now, is that turns into a security deposit?
It does, and we'll talk about that in just a second. But part of that's going to be the security deposit, not the full $5,000, but part of it will be security deposit. Typically about $2,000 in that case.
And then is that taxable because of the option just expired?
Yeah, if I treated it that way, then the $2,000 security deposit would not be taxable, but the $3,000 that they forfeited would be taxable at that point. And you can move them out and resell to a new buyer, which I rarely do, but it can happen. You know, if the people, a lot of times people just leave. Sometimes, you know, they can't buy, so they get transferred out of town or whatever, they just leave and they're gone, in which case we sell it to somebody else. But if they want to stay, we'll work it out with them. And I've had people give me money for a lease option, have a lease option for a couple of years, not close, rent for 4 or 5 years, and then come back and want to buy again. And that's happened recently during this little downturn thing. So, you know, it kind of goes through cycles sometimes. And as long as somebody stays in the house, pays the rent on time, takes care of it, I'll probably let them stay there for a while. If there's trouble, this is a house I don't want, I'm going to sell it to somebody. Number 3 says you may have to evict or foreclose to regain possession. Eviction's a lot quicker, a lot less costly to the tenant and the owner. And rather than foreclosing, if we ever got in a position where somebody wanted to make an argument and I had to hire a lawyer, I'd rather try to buy them out. And you know, generally people who have given you a small amount of money who are renting can be bought out for a relatively small amount of money. You're not talking about you know, $20,000 or anything. Generally, if you give them $5,000 back or $2,500 back, enough money to move and rent another place, they'll move. So the last resort is going to court to evict somebody or to foreclose on somebody. I've had, I think, a total of 7 evictions now in 40 years, and that's with over 1,000 tenants. So it's a really small number because I work with people, and I'd rather help them get someplace else than go through the whole court process of evicting them. On page 19, strategies for selling and lease options. Decide which properties you want to sell. Don't sell your best house. The house most people want to buy from you is your best house. Don't sell that. Keep your good houses. Sell the stuff that's your worst house. So I literally keep a hit list, and that hit list lists my best house to my worst house, and I know exactly which one I want to sell next all the time. You know, if I'm going to sell one, it's not going to be one of my top 20, it's going to be one of my bottom 10, so it's going to be at the bottom of that list. So know which ones. And sell on purpose. Don't sell when the market's going up 20% a year. Why sell? Have a little fun. Raise your prices. And don't sell all your houses on lease options. Structure the terms to help your buyers succeed. We like to help, we like to qualify our buyers. I'm not a licensed lender, although I have made loans to people in the past. So I know what to look for. I know what percentage of their income should go toward their house payments. Is about 40%. I look for other obligations they have, like student loan debt or car loans, mostly car loans. I mean, some people have student loans, but everybody's got a car loan. I had one fellow wanted to buy from me. He had a dog loan. He bought a dog. His payments were $250 a month. I would not sell to this man. But you know, people finance everything anymore. I mean, it's pretty amazing. It was. I guess it was a nice dog. I don't know. Okay, got a question here I want to answer. The question is, why do I don't sell all your houses on lease options? And I mentioned this a second ago. 2 reasons. Number one, you wouldn't want to, let's say you had 5 houses, you wouldn't want to sell all 5 of them in 1 year. They give you a whole pile of money sitting in the bank at 1% interest. That would be bad strategy. You pay a whole bunch of taxes. And if you sold all 5 of them in 1 year, you tell me, what's the market doing? It's hot. It's going up. You don't want to sell all your houses in a hot market. You like to sell ideally the day they hit the top, but it's a little hard to do that, okay? But you don't want to sell them when they're going up, when you're in a rising market, because you're going to lose 10 or 20 or 30% of your money. Just bad strategy. So structure your agreement so they have enough down payment to qualify for a conventional loan at the end of the agreement. So have some kind of number in your mind you're trying to hit and know about what it's going to cost them to move into your house. Have a friend who's in the mortgage business who you can call up and say, I want to send this couple over. I want you to qualify them for a loan. I want you to let me know if there's a chance that they can get a $200,000 loan sometime in the next year and what steps they'll have to take to qualify. You tell them. They may have to pay off a car. They may not have to buy no new cars this year, no new televisions this year, because people do stuff like that and it ruins their credit. So you get somebody else to tell them what to do. And then build in a refundable security deposit for those who change their minds. When somebody gives me $5,000 down, I call $2,000 of it a security deposit. Okay? And those are just round figures, but that would be a real number. Never more than half, but someplace approaching half of it, because you look at what the normal security deposit for that house would be, and that's kind of what I go after. And I say to them, if you don't buy this house, but you give the house back to me in good shape, you've taken care of it, everything looks good, I will give you a security deposit back. Now, a lot of people that sell houses on lease options don't give anything back. Okay? So this money I'm giving back is sort of a gift, but it's a good business decision, I think, because I want that house back in decent shape. If they don't give me the house back in good shape, can't it cost me more than $2,000 to put it back in good shape? Sure. So if the carpet's good, the paint's decent, the grass is mowed, it's clean, and I can sell that house or rent it to somebody else the next week, that's worth $2,000 to me. I'm delighted to give that money back to them. Plus, it gives them an easy exit point. It makes it easy for them to leave that house because they have some moving money. If you don't give them a dime back, what's likely to happen? They just won't move. They just won't move. They just not pay you rent for as long as they can so they can save up enough money to move someplace else, okay? And that's not a happy ending. So you want a happy ending. You want to give them enough money back where they're happy, not delirious. I don't want to make them delirious. I'm not going to give them. And here's the other point. If you don't write down anything, if somebody gives you $5,000 as an option deposit and a year later they can't buy the house, how much will they try to get back from you? $5,000. So it's important for you to write this down going in up front. It's not a big deal going in up front, but you write it down, you have it in your agreement, they understand, and if I do that, I've never had anybody come back and ask for more money. Okay? So I think it makes a lot of sense. You're deciding whether or not to finance a sale if they exercise the lease option. If you do finance a sale, you can't do an exchange. Once you sell it, carry back a note and mortgage, you can't do a 1031 exchange. If you're a dealer, you can't qualify for installment sale reporting. Some folks are confused about this, but if you buy a house, fix it up, and sell it, that's dealer property. You cannot installment sale that and defer taxes. You have to pay the taxes on the profit you made, even if you don't get all the money the first year. C, you can extend the lease option rather than using short-term financing, and that's typically what I'll do. I'll give them 1 more year in a lease option or 6 more months in a lease option, see if they can't get their act together. D, if you sell and carry a note, use paperwork acceptable to note buyers in terms that make the note most valuable. If you sell and carry back a first mortgage on a house, and then you go to sell that first mortgage, How much will you get for it? Let's say you sell a house for $150,000 and you get $30,000 down and carry back $120,000 first, 7%, 10 years. What do you think the cash value of the $120,000 first is? It's about right, about $80,000. Put those numbers in your head and think about them for a second. $120,000 down to $80,000, $40,000 discount, and that's on an owner-occupied first mortgage at 7%. In this market, where you only get 1% in the bank, wouldn't you rather have the first at 120 than 80 grand cash? Yeah, that's what I said too. I didn't sell it. If you sell stuff and carry back notes, you'll get a lot of letters from people trying to buy those notes from you, just like you do when you sell houses. Buy houses, you get a lot of letters from people, and those are pretty much real numbers right now. Scary.
Can you carry back a note, according to Dodd-Frank, if you sell it to an end user?
Sure. You have to play by the rules, but you can carry back a note. There are rules. Term, interest rates, how many. So you got. This is not the Dodd-Frank course, so read the rules. I did a whole newsletter on that. There's a lot of rules, but understand them. It doesn't say you can sell and carry back. You just say if you sell and carry back, here's what you have to do. Okay, so just play by the rules. Okay. Now, I've never been a big seller. If I sell one property a year, that's a big year for me. I generally sell one every 5 or 6 years. So, I'm not any place close to violating anything that looks like Dodd-Frank. But if you sell, remember you're selling to consumers. And when you sell to a consumer, an owner-occupant, a lot of rules apply. If you sell to me, you can sell me all your houses in 1 year. There are no rules. Okay. So if you do need to liquidate, if you need to sell 5 houses in a year, sell them to another investor. Okay, sell them with an option to buy some of them back if you want to. Do something creative, but don't go sell them all to users, because then if you do finance them, you might have a problem.